Hello, welcome to Strictly Money at the News Forum, where all voices matter. I'm your host, Saijal Patel. Renewed optimism among investors on hopes that higher prices may have peaked has quickly vanished. Red-hot inflation numbers out of the U.S. all but guarantees that both the Bank of Canada and Federal Reserve are not done hiking rates to fight inflation, even if it hurts economic growth. Joining me now with his thoughts is Sebastien Mc Mahon, Chief Strategist at IA Financial Group. Sebastien, great to see you again.
Hey, great to be here.
You know, it was interesting because we started to see enthusiasm on the part of investors, and they thought that, hey, maybe inflation has peaked and it's trending down. Not so fast, right?
Yeah, exactly. And the Federal Reserve has been very clear on that, the Bank of Canada too, that they need to see broad evidence that they're winning the fight against inflation before they can even stop about thinking to stop hiking rates, and even at some point, pivot towards maybe lowering rates when needed. And we're not there yet. We're still seeing a broadening of the inflation pictures, meaning that there are more and more components that are rising at 3, 4, 5% year over year. And it's good to see gasoline prices fall down a little bit here, which is, of course, has a huge footprint on the CPI number. But now the focus is turning very squarely on services inflation.
Yeah, so let's talk about that, Sebastien. When you dig into the inflation numbers, and I'd say both sides of the borders, how are you reading it? What are some of the particular things you're noticing?
Yeah, well, we see that inflation is going to be likely stickier than most market participants seem to be thinking recently, at least. So when you look at goods inflation, you're starting to see it come off because of the price of gasoline. It's been helping that the U.S. has been, taking some stock out of their strategic reserve just to help, with the supply in the market, helping pushing the price of oil lower. Strong U.S. dollar also helped pushing the price of oil lower. So that helped the goods component. But when you look at the services component, this is tightly linked to wage pressures, to wage expectations. And if we'll make a parallel with the 1970s and early 1980s, we had two episodes where inflation was very strong. And in both episodes, we had the goods component peaking about 1 or 2 years before the services component. And on both occasions, it took a recession to break the back of inflation. And it's not a coincidence that central bankers, especially in the Fed now, they're quoting Mr. Volcker a whole lot. They're trying to avoid the mistakes that were made under Ultra Burns. So the mindset of the Fed now and of the Bank of Canada is they need to fight to the end.
So when you say services, it is related to wages?
Yeah, exactly. So services, think about restaurants and hotels, and the price pressures in services is tightly linked to the labor market and to wages. So the hotter the economy, the hotter the labor market, the hotter this will keep on, and the higher the risks that we have persistent inflation because with the anchor inflation expectation. So this is now the fight for the coming quarters.
Sebastien, it was previously, there was a lot of talk about the supply constraints, right? Even though some of it was demand-led as well. What's happening on the supply side?
On the supply side, we're starting to see good things. We're starting to see the imbalance between supply and demand resolve itself. We're starting to see waiting times that are falling for suppliers. We're starting to see shipping costs that are also moving lower. So this part is not completely resolved, but it's well into its resolving process.
Okay. Sebastien, we have another chart, the global PMI versus the global monetary policy, and we're going to bring that up. Explain what you're seeing here. We have about a minute to the break.
Yeah, sure. So the global PMI is pretty much the global economic cycle. So the blue line that you're seeing here, this is the strength of the global economy. So of course, it's a cycle, it goes up, it goes down. And the red line is our proxy of what's going on with monetary policy. And the lower the red line, the tougher it is for the economy to grow because financial conditions are getting tighter and tighter. And as you can see, the red line leads the blue line by about 11 months here. So what this is suggesting is that the impact of tightening monetary policies around the world is negative on the economy now, and it should get even worse as we move through 2023, making 2023 a real transition year where we could see a softer global economy. And maybe this will be enough to help with the inflation picture, but expect some economic pain to succeed in the fight against inflation.
All right. And I should mention the PMI, it shows the trend of the manufacturing services industry.